The stock market has recovered from some lows we hit in April, but there's still a ton of uncertainty in the market today. And so investors need to be really careful about where they're putting their money and what stocks they're avoiding right now. Today, I'm going to go through 3 stocks that I absolutely love. I love their valuation, their long-term growth potential, and I have 3 stocks to sell. And these are very popular companies, but they're losing money and they're in a much worse strategic position than you might think. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And don't forget to subscribe to the Asymmetric Investing newsletter. There's a link on the screen and a link in the show notes. That's where you can get access to the asymmetric portfolio where I buy stocks every single month. I tell you what I'm buying before I buy them, and then you can watch that market beating portfolio. Beat the market last year, beating the market again this year. Had another great week this week with hims and hers skyrocketing on Tuesday. And I want to thank this video sponsor, FinChat. FinChat is where I get all of the charts that you see here on Asymmetric Investing. In nearly 30 years of investing, this is simply the best tool that's out there for fundamental investors. It's going to give you all of the financial information you need, all the transcripts, all the SEC filings, investor presentations. It'll tell you what insiders are doing. And the latest addition is that they have AI interactions with earnings transcripts. So I'm going to use FinChat with all of these stocks here today, show you just how easy it is to use it. And if you use the link finchat.io/ASYM, you can get 25% off. That's for this week only. That's only through Friday. So if you've ever considered looking at FinChat, check that out because you get 25% off. This is a deal they only run twice a year. So you can get that right now using that link. But I'm going to talk a lot more about FinChat. So let's get into the 3 stocks that I like right now. The first is SoFi. SoFi is a company that I think is still really misunderstood by the market. A lot of investors think this is a bank. This is much more of a platform company, and they're really showing that over the past couple of quarters with some of their agreements. But high level, $14.5 billion market cap. Price to earnings multiple is only about 33. But this is a solid growth company. Let's look at some of the metrics that investors are going to want to keep an eye on. At a really high level, you can see that this is a phenomenal growth company since 2017, 27% compound annual growth rate, and that net income is now solidly profitable. But this doesn't really tell the full story. The way that you're going to want to judge is with how many members they have and how many products those members are taking out, and then what the capital looks like to actually make those products work. If they're lending a lot of money from their own balance sheet, there's going to be limits to the amount of growth that SoFi is going to be able to have. But they've become much more of an asset-light business recently. But you can see that this member growth, compound annual growth rate of 58% since the December 2019 quarter, just phenomenal numbers. This is the latest numbers that came out Tuesday, 10.9 million members. And those members have taken out 15.9 million products. The first is their lending business. This is really the core business of the original business from SoFi. They've added the technology and financial services businesses later, but the lending business has done extremely well. You can see that revenue growth has been really solid, 41% compound annual growth rate since the end of 2019, and now solidly profitable. What's interesting in the lending business is that SoFi is having less and less of these lending products on their own balance sheet. It used to be that they used to lend from their own balance sheet. Now they're using what they're calling their loan platform. That originated $1.6 billion worth of loans in the first quarter of 2025. That is increasing dramatically. That will make the company more asset light and more fee based. So we're still going to have a very high margin business in lending services, but it's not going to have the same risk that you have with the typical bank. What you could have happen if that strategy is successful is that SoFi will now be valued more like a technology company and a company that can grow exponentially without raising more capital, rather than being valued like a bank, which is going to be valued more like 1, maybe 1.2, 1.5 times book value. So that's really the upside here. If this strategy to move to more asset-light business is successful, could unlock a lot of growth and a lot of profitability. The technology platform is primarily the Galileo business that SoFi acquired. And this is basically white labeling a lot of the services that you're going to get from SoFi. So when you see a company like H&R Block having a savings product or a debit card, that could be something where SoFi is actually the technology behind the scenes. That's a business that has been growing a little bit, not a high growth business right now, but just a steady business that continues to generate positive contribution profit, as they call it. We'll see if that gains more traction over the next couple of years. I look at this business as more optionality because the 2 core businesses, the lending business and financial services, those are really the businesses we want to see solid growth. So let's get to those financial services. This is really the exciting segment right now for SoFi. This is going to be everything from their stock trading to credit cards, and even their loan platform business is actually going to end up here. The lending segment includes all the loans that they're holding on their balance sheet, but the loan platform business is going to end up in this segment in financial services. So that's going to be another growth piece, but also a very high margin growth piece. You can see that in the most recent quarter, $303 million worth of revenue, now nearly 50% contribution margin. So this is really solid growth. And the big change for SoFi over the past couple of years has become much more of an asset light company. That's enabling more and more growth in the platform as they're attracting more members. That's where you're going to see the company sacrifice short-term profitability for long-term growth. When you see them sponsoring things like stadiums, the SoFi Stadium in Los Angeles, or the golf league that they're now sponsoring, which I think has given them much more exposure those are going to be brand building exercises to attract more customers, more members. You can see as long as those member numbers and those product numbers continue to grow, this is going to be a great performer for investors. So love where SoFi is sitting today. Uber is number 2 today. Uber has clearly won the ride sharing business in the US in particular. They also have a bunch of services all around the world and investments in other companies that do ride sharing. But they are really the aggregator in this market. That's why they've gotten to the valuation they have, $163 billion valuation as I am recording today. On a forward basis, that price to earnings multiple, 32, not the cheapest stock that you're going to get, and you are going to pay a little bit of a premium for having the leader. But look at the financials that we get from Uber. Since 2016, that compound annual growth rate is 36%. Just phenomenal. Part of that is adding all the food service and food delivery that they've added over the past few years, and they're now solidly profitable. They have pushed their prices a little bit higher, their take rate a little bit higher. That's why you're seeing almost $10 billion worth of net income over the past year. The real opportunity for Uber, though, is moving into autonomy. At the end of the day, this is a networked business, and Uber's business is to connect demand with supply. And that supply is really the power in the market. If you have the most supply on your ride sharing network, you're going to have the biggest market share, and that's going to be a flywheel effect that's going to keep churning. That's what keeps Uber in the lead today. The change in the market is going to be autonomy. Autonomous vehicles could help increase the supply and reduce the cost to operate those vehicles. So we could see ride sharing services going from $2 to $3 per mile to as little as $1 per mile. What kind of businesses does that open up? How many more opportunities do you have to move people around or food or other items around if there's nobody in the vehicle? I think that's really one of these things that's going to 10x the potential market size of the business. Uber is very well positioned. They've got a bunch of partnerships that they're trying out right now. Alphabet's Waymo, they're operating their service on the Uber app in a couple of cities already in the US. Then you have Volkswagen, which is powered by Mobileye. They're going to be launching in the Los Angeles area in 2026. You have May Mobility. There's a dozen or so companies that I think Uber is going to work with. And ultimately, if autonomy itself and the ownership of those autonomous vehicles becomes basically a commodity, the value in this industry is going to accrue to Uber. That's why I think this is really a hidden way to play the autonomy business, because as more and more vehicles are autonomous and they get on the roads, how are we going to interact with them? Are we going to have a dozen services where we're calling for different rides? I don't think that's going to be the case. That's not the way that it works in taxis or ride sharing today. Uber is the dominant player. I think they're going to continue to be the dominant player. I also like Lyft. I'll give them a little bit of a shout out on both of those stocks because of this tailwinds from autonomy. But Uber, I think, is going to be the most sure bet. And so they are going to have a decade or two of tailwinds, just integrating autonomy more into their business model. Number 3 is really a value stock. That is MGM Resorts, $9.1 billion market cap. This enterprise value actually includes all of the rent that they need to pay for their resorts over the next 20 or 30 years. So don't quite look at that number, but I'll get to their financials in just a second. Price earnings multiple, just 13 right now. And what they're doing is they're generating a ton of free cash flow. They don't have a ton of investments to make in new properties. Remember, they're not building anything huge on the Las Vegas Strip, for example. The one casino that they're building in Japan, they put a lot of the money that they're going to into that resort. That's not going to be open until 2030. So a lot of optionality for growth. But what you see is they're just consistently generating free cash flow. Remember, $9 billion market cap, generating 1.7 in 2023, $1.2 billion in free cash flow in 2024. And that doesn't include a full ramp up of operations in Macau, which was still in 2024 impacted by COVID and some of the shutdowns there. But ultimately, what are they doing with that cash? A big use of their cash right now is just reducing their shares outstanding, buying back stock at about a 15% of shares outstanding clip over the past couple of years. You can see that really started at the end of 2021. That was when they were selling some of their properties to VICI Properties, but they're also now just using their cash flow to buy back stock. They don't need to reduce their leverage. They have a reasonable amount of debt on the balance sheet. You can see that here. The gold is the amount of cash that they have on the balance sheet. So as the end of the fourth quarter, about $2.4 billion worth of cash and short-term investments. And then debt stood at about $6.4 billion. So that's a reasonable amount of debt for a company that's generating this much cash. And I think you're getting a great value on the core business today, but the optionality is in really 2 segments. You get optionality for growth in the digital business. So that includes BetMGM in the US. And then they own most of their operations in most international markets. They're expecting that those are going to be EBITDA positive this year. So they should start generating cash flow and actually pushing money back to the mothership. The other big growth opportunity, and I think this is not really realized by the market, is Japan. That is going to be the only casino that is going to be built in Japan. That's going to open in 2030. It's about a $10 billion casino. I think that could generate more than $2 billion worth of adjusted EBITDA, which is a proxy for cash flow coming from these resorts. That's what Marina Bay Sands does in Singapore. Japan, larger economy, more money in the area, still an area that really likes to gamble. So I think that's going to be a very profitable casino. They're going to own 40% of that resort. So that could be $800, maybe $1 billion worth of free cash flow just coming from that one resort. I think that's really underappreciated. So we could have shares outstanding reduced dramatically by the time that casino opens up. The next 10, 20 years, I think this is going to be a phenomenal stock to own. Just a great value to get today. Got to get through the uncertainty over the next couple of years. What happens with tariffs? What happens with the US economy? but very well positioned, much lower risk than we've seen in the casino industry for a very long time. So those are the three stocks that I really like today: SoFi, Uber, and MGM Resorts. But what stocks are taking on too much risk? Let's go through three of those. One that continues to be on fire that really surprises me is IonQ. This is one of the quantum computing stocks. Gotten a lot of attention. You can see that starting kind of in the fall timeframe in September 2024. Shares were trading for $7.18, now up to $28. The market cap, $6.9 billion. So now a pretty sizable company. But what do you get for that business? For $6.9 billion, you get a business that's generating $43 million worth of revenue. Let's add in net income, lost $332 million over the past year. And free cash flow, what does that look like? Negative $124 million. It is very possible that IonQ continues to grow and is a disruptive company in quantum computing. But we don't want to pay this kind of a price for that growth. When you have an enterprise set value to sales of 150, that just typically doesn't work well for investors. The company's going to have to continue burning cash, probably going to have to continue selling stock, raising money with debt. That would add more risk to the balance sheet. And we don't know when it's going to be profitable or how profitable it's going to be. The companies that IonQ is really trying to compare itself to that have been real disruptors in technology were profitable very early in their life cycle. So this is the kind of investment that is extremely risky. And unless you think this is going to be a company that could be worth $100 billion, $500 billion, it's just not worth the risk today, because it's much more likely that the stock drops 80, 90%, because investors realize that those profits and the potential high margin just isn't going to show up anytime soon. I think this is one of the stocks that the market is valuing extremely highly that I would just stay away from right now. The second one is another one I know I have a very contrarian take on. That is Rivian Automotive. Two things can be true here. These can be great vehicles, and this can be a terrible business to invest in. We are buying this company for $15 billion, and they are losing money. Right now, General Motors has a market cap of $45 billion, so just 3 times more expensive, but they are generating a ton of cash. Price to free cash flow is just 5. They're generating almost $10 billion worth of cash right now, and they're using that to buy back stock. What is Rivian doing? They are burning cash. And I think the thing that's most jarring with Rivian is that they're not really increasing their production. Yes, they plan to as they introduce R2, but they don't have excess demand for the R1 vehicles that they're currently making in Normal, Illinois. That's why they have to produce those R2 vehicles in Normal. What they should be doing if they had excess demand for R1 is they would say, you know what, Normal is going to be an R1 facility and we'll build out the Georgia facility for R2 and R3. But that's not what they're doing, because they can't sell more than 50 or 60,000 R1 vehicles. That's where we see things stalling out for them right now. So the next phase is building out R2. You got to do that in Normal, and then you got to build out the Georgia plant. That means that this cash burn level is not going to get better anytime soon. The caveat here for the most recent quarter is that they actually had some benefits from their deal with Volkswagen. They took that cash onto their balance sheet, but then they need to earn that cash. It's unearned revenue at this point. So this number is going to go back up to more like $4 or $5 billion on an annualized basis cash burn. And while it looks like Rivian has plenty of cash on the balance sheet, $7.7 billion worth of cash, they also have $4.4 billion worth of debt. And this cash is going to disappear pretty soon as they're burning money with their current operations and building out that Georgia facility. Remember, they need to get the loan from the US government to complete that Georgia facility. Without that, that facility is not going to be built, and Rivian is in serious, serious trouble. And now that we have the Trump administration in charge, it's unclear when that money is actually going to be distributed to them. So a lot of questions overhanging Rivian. And meanwhile, competitors like General Motors, like Ford, like Volkswagen are all introducing more and more electric vehicles. They're taking more share. And by the way, the EV market is not growing a significant amount. So there's a ton of pressure on the demand side for electric vehicles as supply is increasing. That's not where you want to be as a manufacturing company. And investors definitely don't want to pay a high price for a manufacturing company, especially a company with $4.4 billion worth of debt. And by the way, if they do get that loan from the US government, they got to pay that back. That's going to be a loan. That is not a gift or a grant. They're going to have $11 billion worth of debt if they do get that loan and build out that Georgia facility. So pretty poor position for Rivian. Doesn't mean the stock can't go up in the future, because this has become something of a meme stock, but the operation's just in terrible position today. And I don't think this cash burn is going to end anytime soon. Finally, Lucid, a similar position to Rivian, $7.6 billion market cap. Look at this, enterprise value to sales is over 9, but they are losing money like crazy, and actually probably in a worse position than Rivian is. They lost $2.7 billion in sales of just $808 million in the most recent year. They're trying to move a little bit down market. They're introducing some vehicles that are a little bit lower cost, but the pressure is going to be on these high-end, expensive vehicles right now, especially if we have a weak economy and rising interest rates over the next year or two. Both Rivian and Lucid are really going to struggle with that, because it's going to make it more expensive to take out a loan to buy a $80, $90, $100,000 vehicle. And that's what these companies are selling. That's where the price point is for both Rivian and Lucid. I think that's going to be a tough spot to be in. And really, a lot of investors' thesis with Lucid is that the Saudi Arabian investment fund is just going to bail out the company or take the company private. I don't think that's the case. They have debt in Lucid. If Lucid ends up going bankrupt, they're going to still control the company. So why would they go out and bail out current shareholders? Again, you got to look at those fundamentals with these companies. Are manufacturing companies making money? Do they have good enough margins to support the investments they're making? Is there return on investment, ROI, or ROE, return on equity, ROA, return on assets? All three of these companies I mentioned here, Ionic, Rivian, and Lucid, all have negative returns no matter how you look at it. That is not a good position to be in as an investor. And that's why I'm staying away from all three. So if you want to find out what I'm buying, check out Asymmetric Investing. Like I said, there's a link on the screen, a link in the show notes. We'll be buying stocks later this week. But the three that I really like right now, SoFi, Uber, and MGM Resorts. Three that I would absolutely get rid of, Ionic, Lucid, and Rivian. Let me know what you think of those 6 stocks. Leave your comments in the comment section below. And check out finchat.io/ASYM. It's one of these products that I think once you start using it, you're really going to love it, especially if you are in the financial services industry. Thanks for watching, everybody. We'll see you here next time.